You don't need an overcomplicated portfolio to build passive income. And in today's video, I'm going to show you exactly how you can structure a portfolio to build passive income. If you're new to the channel, I'm Santiago. I'm a professional investment analyst, and I help seven-figure investors build and manage their portfolios. So in today's video, we're going to cover three things. First, we're going to walk through the steps to building passive income in your portfolio. Second, we're going to talk through some of the asset classes in the alternative investment area that will help you build passive income. And then third, we're going to walk through a real life case study where you can see how an investment analyst walks through and solves this issue for clients. So as an investment analyst, the first thing that I'm going to look at when I'm trying to build passive income in a portfolio is the total balance sheet. I like to call it the kitty, stealing a term from poker terminology. What is the total amount of assets that we're working with? The reason that this is important is because it lets us know our maximum capability. Like, what are all the possibilities? And let me give you an example so this makes sense. Let's say that we want to generate $200,000 of passive income, and we have a $1 million balance sheet. Well, this means to generate that passive income goal, we would have to take our entire balance sheet, every asset that we own, and generate a 20% yield on it. This is unrealistic, as it would take on a lot of risk in the portfolio, and we don't want our entire portfolio in one vehicle that's just generating yield and not continuing to grow the balance. So we want to write down what is our total net worth. Next, after writing down our total kitty and net worth, we want to write down what is our passive income goal, annually, monthly, whatever the number is. And we want to compare our balance sheet to what our goal is. And this is going to give us one or two forks in the road that we need to go. The first fork is that our balance sheet is not big enough to generate our passive income goal. Therefore, we need to focus on growing the balance sheet and then reallocating assets that will build passive income for us at a later time. The other option is that our balance sheet is large enough to generate our passive income goal safely, and therefore we're at the point where we can start identifying alternative investment assets that have a passive income component and start to reallocate our portfolio. Either way you go, it's a solution that's moving you in the right direction to get you to your passive income goal. Once you determine the balance sheet and the passive income goal, you're then going to just make a list of all the available options. We want to use all the tools in our toolkit. This channel is dedicated to thinking and investing like the 1%. So we want to use all the available asset classes and not just limit ourselves to bonds that don't pay a very high yield. The traditional portfolio is a 60-40 mix where 40% of your money is getting around 3 to 4%. But when we use alternative asset classes, we can get a higher yield, albeit with a little bit more risk and less liquidity. But this may allow us to open our portfolio up some more and reach our passive income goal. So let's make a list of the asset classes. You guys have heard me say this on many different videos that I've created on this channel. We have the Pentagon of assets. We have private equity, private credit, real estate, commodities, and hedge funds. So once we list out the asset classes, we can just look around in the markets, do a little research. We want to know the average return and the average yield for the asset class. If you don't know how to find this information, you can download the JP Morgan Guide to Markets and get the information on the returns quilt in the presentation. So once we have a gauge around our assets, understand what the playing field is, let's walk through a case study where we're going to look at how this would play out in a real life scenario. But before we dive into the case study, if you're getting value out of this information and content, go ahead and do me a favor and click the link in the description below and sign up for my email newsletter list. In the email newsletter, you're going to get updates on what's going on with the channel and also receive updates when I do free giveaways like my AI prompts and portfolio investment management information. So click the link in the description, subscribe to the email newsletter, and you won't be disappointed. So let's walk through a real world situation and how an investment analyst would approach this to solve this problem. Let's say we have our client and the investor wants to generate $7,000 a month in passive income, and that would equal $84,000 a year. And the current kitty, the balance sheet, is sitting at $1 million in a 401k. And he also has $1 million spread out between investments and cash that he just has on the balance sheet. So no matter if you have $1 million, 500,000, this process is going to work and it's going to apply, and it's exactly how we do it as professional investment analysts. So first things first is we have 1 million of the portfolio. So half the portfolio is in a qualified account. This is the 401k. So we can't use this money just yet. In this scenario, let's say our subject is under the age of 59 and a half. They're still working and they can't pull from it, and they still want to generate some passive income for it today. So we're going to leave that 401k money alone. It's just going to sit there and build. So we're going to work off of $1 million. If we wanted to generate $84,000 a year on $1 million, this would mean we need to have, on average, a 8.4% yield. But if you remember what I said in the beginning of the video about needing to continue to grow the portfolio, the $84,000 that we generate now, today in the portfolio, is not going to be the same as $84,000 10 years from now. So for that reason, we need a combination of both growth and yield in the portfolio. And at a minimum, this growth should match the inflation. It should always be matching, what would be the increase of cost of living. Hopefully it would get more than that. So how do we put together a portfolio and a combination of assets that allow us to build both the passive income component and also continue to grow our portfolio so that we can maintain our lifestyle and continue to grow our wealth? Well, the first thing that I'm doing is listing out each asset class and just the average return on the strategies that I may have available. So we're going to list out, the average returns on private credit, which gives us a yield. And we're going to list out the average returns for real estate. And we just want to play around with some of the numbers in Excel and figure out what combination would get us in the ballpark, just playing around with it a little bit. And what we want to discover when we're playing around with this is how can we build a scenario where, one, we can continue to grow the portfolio, two, we can reach the income need, and three, we are not taking on a lot of unnecessary risk. So if we were to take the portfolio and we see that private credit is yielding at 10%, and we just dump the $1 million in private credit and get the 10%, great. We reach the income goal, but the portfolio is not going to grow. It's just going to give us our dividends every month or every quarter, and that's just going to be the end of it. So we know we can't do that. We also know we can't do it because if we were to put the entire portfolio into one asset class or one investment, we've just increased the risk of the portfolio substantially. So that's not a good idea either. So we need to create a blended effect that allows us to create this 1% portfolio. When we talk about investing like the 1%, it's using a combination of asset classes to build a portfolio that is all weather, that can both grow and give us short-term benefits like the yield. So first, what we can look at is saying, let me tilt the portfolio into the highest yielding vehicles. And in this situation, this is definitely going to be credit. When we think about credit, we're lending out money to receive interest rate back, just like a credit card, right? We're getting some form of interest back by lending out money. So once we identify credit is going to be a higher yielding component, we can put that in our portfolio bucket. And we're not going to worry about percentages for now. We just want to identify what assets we want to use. Next, we can identify maybe some bespoke strategies. GP stakes is one of these bespoke strategies. If you're not familiar with GP stakes, I'm going to link a write-up in the description that goes over GP stakes and how this investment strategy is used from Blue Owl Capital. I do not endorse Blue Owl Capital. It's purely for information, educational purposes only, but this will give you an idea of how this strategy works and how it yields. And then let's say in our GP stakes strategy, we can get an 8% yield, for example. So we're going to get 8% return on GP stakes, 9% return on private credit. But we still need a component of growth to keep up with inflation. But there is a little piece of it that we left out when we're looking at this portfolio. So if you remember that other $1 million that was in the 401k, this is still part of our overall portfolio. This money is still going to continue to grow in the stock market. So in this instance, even though we can't use the $1 million in our retirement account as a passive income vehicle today, we still have it as a growth component that we can reallocate in the future when these funds become available. So if we know that we're growing 50% of our portfolio in our 401k at 9%, let's say, in stocks, we then know that we can be more aggressive on the non-retirement money to get our yield for today, right? We can move and shift the portfolio. That way we have part of it in stocks that are growing in one style of account. And in another part of our account, we can use alternative assets instead of just keeping that money in the stock market as well. Because remember, retirement accounts have limits. Your 401k has a limit, your IRA has a limit. So you're only going to be able to put so much money in it per year. So you may have a lot of money that's sitting on the sidelines that's not deployed yet. We can use this to identify our alternative asset classes, identify what is the average yield, and then begin to allocate to these other asset classes that build us our passive income. So what I've done here is created a table of an asset class breakdown and theoretically how you would get to your 8.4% yield or a little over it. Now, with this being said, this is all hypothetical. This is not financial advice. I'm not telling you to take your $1 million and go do this. Always talk to a financial professional. I run this channel to help others invest and think like the 1%. So please don't go out there and do something you're not supposed to do without the guidance. There is a reason that professionals do this job and that I'm qualified to do this. So that should go without saying. But as we can see in the table, when you mix together the variety of alternative asset classes, you can create this passive income yield that you're searching and still simultaneously grow your overall balance sheet to either create more passive income in the future and also be able to maintain the inflation and lifestyle. And this is the power of alternatives. If we were to remove our ability to use alternative investments, our ability to use credit, GP stakes, all these other strategies, we would then be just left with stocks and bonds. And stocks and bonds are great, but with bonds only returning around 3 to 4%, where is our passive income component going to come from? So you may be sitting here watching this video and saying, this is great, but Santiago, I don't have $1 million to invest in alternative assets. You know, maybe I only have $250,000 in my 401k. How can I still build a passive income component? Well, as I said in the beginning of the video, there are two forks in the road that we can walk down to solve this problem. Your fork may be still in the growth stage, and that's fine. If you are in the growth stage, you can still focus on high growth assets that then will be reallocated in the future. And we can get the exact timeline that we need by just working backwards and doing a little math. So let's walk through another example. Let's say right now you're sitting at $500,000 and you want to generate $100,000 of passive income. So we know our ideal target is probably around $1.5 to $2 million. It's not $1 million at 10% average yield because, of course, we don't want the entire portfolio in one asset class. So if our target is around $1.5 to $2 million, we then can set our time frame. Let's say our time frame is over the course of the next 10 years, we want to reach this goal. And then we just do some simple math and say, what return do I need to grow $500,000 to $1.5 to $2 million over the next 10 years? And this return that's needed gives us the amount of risk that we need to take in the portfolio to reach this goal. Oftentimes when we do this math, we find out that the amount of risk that's needed to actually meet a investor's goals is way less than they're taking in their portfolio. Investors feel like they have to take all of these unnecessary, risk and all these different investments to create their passive income in their portfolio. But maybe you only need a 7 to 8% return. You can play it pretty conservative over the course of 10 years and then begin to reallocate those assets to passive income. So no matter where you are in your portfolio growth journey, you can begin to use all the assets available to create the passive income. I'll share a personal story about myself. At 35 years old, I said, I love taking vacation. I love traveling. I don't want to pay for it out of my salary. I feel like if I'm paying for it out of my salary, I'm kind of moving backwards. And for that reason, I looked at different type of asset classes and shifted my portfolio to support my vacation expense for the year. So now I can go on vacation, stress-free, worry-free. It's already paid for by passive income, and I don't have to worry about taking it from my working income, even at the age of 35. And this doesn't support my total lifestyle. It just supports part of my lifestyle. So if you found value out of watching this video of how to create passive income, make sure you check out my video on why private equity is spending billions of dollars on professional sports teams to learn about growth private assets. And make sure you click the link in the description to sign up for my email newsletter so you can stay up to date with all things alternative investments with the Finance with Santiago email newsletter list.